Hello my dear student. Once again let us take one more case study, that is case study number 9, and I hope till now we have already recorded up to case study number 8 and you have already listened all the case study. Any doubt regarding that case study you can post in the comment box. Okay sir? Yes sir. So can we start? D Limited is a global company and prepare and present is financial statement following international financial reporting standard. I have already said that wherever IFRS written, just consider it as Ind AS. Okay, as its securities are listed on New York, so just delete it and write on Indian Stock Exchange. Indian Stock Exchange. D Limited has a number of business segment. D Limited is a manufacturer of defense equipment. It takes about 10 months from the receipt of material for manufacturing to the completion of product being ready for delivery. The customer for this supply is the Ministry of Defense, and it takes about 9 months from a date of invoice, that is date of sale, to make the final payment. Means of course this is a question related to operating cycle, current asset definition, current liability definition. So you can see OC will be 19 months. Understood? D Limited has entered into a contract with AM Limited for modification of their manufacturing facility, which is having a single performance obligation. Based on its experience, D Limited determined that this contract will take approximately 300 hours in total to complete the project and charges 250 per hour. After incurring 150 hours of time, D Limited and AM Limited agreed to change an aspect of the project and increase the estimate of labor hour by 100 hours at a rate of 150 per hour. The entity recognized the effect of the modification on a cumulative catch-up basis. It is given that we need to apply accounting treatment on cumulative catch-up basis. I hope you remember the cumulative catch-up basis. So in this case, what is given? The initial number of hours was 300 and the agreed price was how much? 250. So it is coming how much? 300 into 250. How much? It is coming 75,000. Correct. Then they have given that it is given that after incurring 150 hours, so already they have recognized the revenue of 150 hours based on 250 rate, but there is a modification and they want to increase the number of hours by how much? That is, it is given 100 hours and the rate for this 100 hour will be based on 150 per hour. So it means it will be 15,000. So now what is the total? You can see total will become how much? 400 hours. Correct. And the total will become 75 plus 15. That is how much? 90,000. So what will be the hourly rate? 90,000 divided by 400. So 90,000 divide 1 minute. 90,000 divided by 400. It is coming how much? 225 hourly rate. So it is coming 225 hourly rate. Now can you say for 150 they have already recognized revenue based on what? 150 per hour. Means how much revenue they have recognized? Revenue of 150 hour based on 150 rate, 250 rate. So how much revenue is already recognized? 150 into 250 is equal to how much? 37,500. But they should recognize revenue now based on 225. So it will be 150 into 225. How much? So 150 into 225 is equal to what? 33,750. It means they should decrease the revenue by how much? Minus karo 37,500. So you should decrease the revenue by how much? 3750. So this can be one of the possible questions. Let's see what is the MCQ given. Okay, I hope you have understood. D Limited is having an investment in equity share in another company, F Limited, as at the end of reporting period, that is 31st March 2003. So they have the investment in equity shares of another company after the end of reporting period, but before authorization of financial statement, it has been found that value of investment was fraudulently inflated, committing a computation error. So what they are saying, before approval of financial statement, one of the mistake was identified, that value of investment was done with some error. So of course before approval of financial statement it is identified, so this will be an adjusting event. Let's see what the question has been asked. D Limited is in the process of acquisition of shares of MT Limited as a part of business reorganization plan. The projected free cash flow of MT Limited for the next 5 years is given. You can see the cash flow has been given year 1, year 2, year 3, year 4, year 5. And terminal value means what is the disposal value of that project. That is what 4,000. 4,000 has been given. The weighted average cost of capital is 11%. The total debt as of measurement date is 1500 crore and the surplus cash and cash equivalent is 100 crore. Total number of shares is how much? 10 crore shares. Correct now. So of course they have asked in this question, they will ask you fair value measurement as per Ind AS 113 requirement. Let's see what the question is given. Then we find out the valuation of shares. U Limited has purchased a software from LT Limited in exchange of machinery which was not in use by the company. So it is the purchase of intangible asset in exchange of another asset. The carrying amount of machinery in the books of D Limited is 20 lakh and the fair value is how much? 21 lakh. The carrying amount of software is how much? 22 lakh and the fair value of software is what? 20.5 lakh. So we need to understand they have asked from which company's point of view, whether they have asked from U Limited point of view or LT Limited point of view. Of course this is a question of what? D Limited. This is a question of D Limited. We don't know. They may ask from U Limited or they may ask from LT Limited point of view. Correct now. So let us check what is the requirement of the question. MCQ. How the entry shall be passed on purchase of software in exchange of machinery in the books of D Limited. Correct now. So purchase of software, so it means they have asked from the point of view of U Limited to U Limited might be one of the subsidiary. Correct now. Are you getting? Got this point? So I think this should be D Limited. There is some typo mistake. The D Limited has purchased. I think it should be D Limited. I hope you are understanding. So there is some typo mistake in there. So just convert U Limited to D Limited. So D Limited purchased software. So they purchase software in exchange of machinery. Correct now. So what is the rule? The cost price of asset acquired will be the fair value of asset given up. So what is given up? Machinery is given up. And what is the fair value of machinery? Fair value of machinery is given 21 lakh. Okay. And the second option is what? The fair value of asset received. So what is the fair value of asset received? That is software. That is 20.50. So of course, the first preference will be given to the fair value of asset given up. So what will be journal entry? Software account debit. What is the cost price? That is 21 lakh. To machinery. What is the carrying amount? Carrying amount is what? 20 lakh. And there is a gain. Gain on exchange how much? 1 lakh. Gain on exchange is how much? 1 lakh. So what is the correct entry? You can see for they have asked for D Limited and LT Limited both. Correct now. In the books of D Limited and LT Limited, the first option, I think this option is correct. Software account debit 21 lakh. To machinery 20 lakh. To gain on sale of machinery 1 lakh. From the point of view LT Limited, what will be journal entry? From the point of LT Limited. Correct now. So can you say for LT Limited, they have purchased what? Machinery in exchange of software. So first preference will be given to fair value of software given up. So what is the cost price of machinery? Cost price of machinery will be the fair value of software given up. Correct now. So here machinery account debit will be how much? 20.50. To carrying amount of software is how much? The carrying amount of software is how much? 22. And you can see there is a loss. Loss how much? Loss on exchange will be how much? 20 means it will be 1.5. So this will be the correct journal entry. So journal entry what? Machinery account debit to software account 22 lakh and the loss on sale will be what? 1.5 lakh. So B option is correct. Option number B is correct. What is the rule? Whenever there is a purchase of asset in exchange of other asset, the rule is what? Cost price of new asset will be equal to fair value of asset given up plus minus cash adjustment or fair value of asset received, whichever is clearly evident. If the fair value cannot be measured reliably of both the asset, then we'll give preference to carrying amount of asset given up plus minus cash adjustment. This is the rule for the accounting. Understood? Come to the next point. Scenario 1. Production time is 10 months and the time lag between the date of sale and collection from customer is 9 months. Means operating cycle is 19 months. Scenario 2, the production time is 15 months. Means they are assuming that production time was say 50 months. Same is assumed. And the time lag between the date of sale and collection of customer is 13 months. So 15 plus 13, it is coming how much? 28 months. 28 months. In both scenarios, the inventory and trade receivable are current in nature. Now what is the rule? Now any asset will be current asset if any one of the following conditions are satisfied. First, it is expected that it will be sold or consumed or realized within company's normal operating cycle. Within company's normal operating cycle, first condition, it is expected that it will be realized. It is expected that asset will be realized within 12 months from the end of reporting period. Third condition is what? It is held for the purpose of trading. Fourth condition is what? It is cash and cash equivalent. Correct now. So you can see 19 month and 28 month. Correct. 19 month and 28 month. And it is given that means just try to understand, inventory will be always considered as current only. Only the doubt will come for trade receivable. So trade receivable is going to be realized in this case in 9 months, in this case in 13 months, which is what? Within company's operating cycle, within company's operating cycle, and therefore trade receivable will be also current in nature. Correct now. And I hope you are understanding. The inventory though will be always current. Inventory cannot be non-current. Inventory cannot be non-current. So in both scenario, inventory and trade receivable are current in nature. This become what? The correct option. I don't think so you are supposed to read the other option, but if you want to read, but the option number A is only correct. Correct. Determine how contract modification with AM Limited will be accounted as per Ind AS 1.5. Already we have done. We should decrease revenue by how much? We should decrease revenue by how much? It is 3750. So answer is given, decrease revenue by 3750. So option number A is correct. Option number A is correct. Now, should the event of fraudulency in value of investment be adjusted in the financial statement? Yes, it should be adjusted. So the event is an adjusting event, hence adjustment required. Option number B is correct. If you want to read other option, read, but option number B is only correct. Whenever there is an error and that error is identified before approval of financial statement, it will be always adjusting event. Any error, any fraud which has been identified before approval of financial statement will be an adjusting event. Determine the value of shares of MT Limited. For that we need to do calculation. So let us do the calculation. So they have given rate of discount as 11%. So write down 11 means 1.11 divide equal to. So this is what? 0.9. 0.9 equal to 0.81 equal to 0.73 equal to 0.65 6 कर सकते हो 66 इक्वल टू 0.59 0.59 मल्टीप्लाई करो 180 इंटू 0.9 इज इक्वल टू व्हाट 162 190 इंटू 0.81 is equal to 153.9, then 200 into 0.73 is equal to 146, then 210 into 0.66 is equal to 138.6. For the last year, we will take 4,000 as well as cash flow. It will become 4,220 into how much? 0.59. It is coming how much? 2489.8. Sum total plus 162 plus 153.9 plus 146 plus 138.6 is equal to, so this is coming 3090.3. 3090.3. The sum total of present value is coming what? 3090. In this we'll add what? Surplus cash and cash equivalent, that will be added. So 100 will be added, and minus will do the value of debt. So what is the total debt is given? 1500. That will be deducted. All liability will be deducted. So this becomes the total net asset. Total net asset of the company. So plus 100 minus 1500 is equal to how much? 169 169.3 divided by number of shares. So number of shares 10 crore. So you can see divide by 10 crore, divide by 10. So divide by 10. What is the answer? It is 169.03. Let's see what is the option given. 169.03 means approximately, because we have taken 2 decimal. So correct answer is 169.03 means around 170. So because we have taken 2 decimal, you can take 4 decimal. So accurate answer will come. Accurate answer will come. So if suppose there are 2 answer related to 170, then you will have doubt. Correct now. So better you take 4 decimal or 5 decimal for correct answer. Okay. But now you can understand that the approximation figure of 169.03 is near to what? 170.55. So that becomes the correct option. Let's see which one is correct. So one option number B only we have taken. We have taken option number B only now. For 1 we have taken option number B. Then for 2 we have taken both are correct. Yes, this is also correct. For 3 we have taken decrease in revenue. This is also correct. 4 we have taken option number B, adjusting event. And for 5 we have taken 170.55. So all options are correct. So very simple. You can easily score 10 marks out of 10 marks for this type of case study. If you are not doing any calculation mistake and you are thoda sa, I will say, conceptually understanding each and every point. Okay, all the best. We'll come with the next case study in the next video. Till then, bye bye, take care, enjoy your preparation. Love you all.